Hi, everyone. Thank you for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser, and we welcome you and hope you are settling in good for a great presentation today. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. I do have to turn that feature on, so I'm going to go ahead and turn that on right now. All right. The presenter will answer these queries during our question and answer portion at the end of the presentation today, but please ask your question when it comes up. And if we're not able to get to your question, leave your contact information as well, and we'll make sure to reach out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Michael Ames is a financial advisor serving in the Lake Norman region near Charlotte, North Carolina. Michael provides personalized investment advice to help you achieve your financial goals. As a graduate of Franklin University with a Bachelor's of Science in Financial Planning, he utilizes a one-on-one approach to develop a customized plan to help you grow, maintain, and transfer your wealth. Michael's goal is to develop a customized strategy which reflects each client's specific goals and needs. He's been happily married since 2011, has 2 wonderful children. When not working or spending time with his family, Michael enjoys golfing, doing yard work, and spending time on the lake. A little bit to know you just a little bit there. That was great. Michael, I'm going to go ahead and turn over the time to you. And I know our attendees will enjoy what you have to say today.
Well, thank you, Marcia. And I'm glad that everyone could join us today on this conversation and educational event about planning for long-term care. Before we start the main part of the presentation, I do want to take a few minutes to talk about what long-term care planning is. So when we talk about assessing the risk of planning, I'm guessing you're probably here today because it's something that is on your mind. When I typically talk to people about this, it is usually around a situation that they have dealt with themselves, whether it's through a family member, parents, cousin, sibling, something like that, or they're well aware of the impacts that long-term care planning has. But I do want to highlight a couple of key points on this. That people, turning 65 today, because life expectancy is much longer now with the advancements of medical technology. There is almost a 70% chance that you could potentially need this care. And I think more importantly to look at it is that 1 out of 5 people might need that care for longer than 5 years. And that's a pretty significant amount of time to potentially need long-term care. So what is long-term care? Let's talk about some of the basics of what it is. Just, you can see here the definition of it is essentially is an ongoing services and support needed because of chronic health condition or disability due to a prolonged injury, illness, or cognitive impairment. Obviously, when we're talking about cognitive impairment, we're looking at whether that's a brain injury, Alzheimer's disease, dementia. If it's one of the others, it might be something from a severe arthritis or heart condition that might cause you to not be able to partake in 2 of the 6 daily living activities. So we talk about, what long-term care is, and then we're talking about the various levels of care. So there are 3 distinct levels. So you have skilled care, intermediate care, and custodial care. They kind of go down in severity. Skilled care is around the clock. I think of nursing home, facility. Intermediate care is going to be something like an assisted living location that you have, where you have a combination of independent living plus some support. And then custodial or personal care is going to be typically seen at the home health care side or by a caregiver. So once we know what types of care, then we look at where you can receive it. Kind of what I just addressed there. Start with, and I would say it's the vast majority of people that I talk to, especially if it's married individuals, you want to be in the place of comfort in your home as long as possible. If that's kind of the first place that we start. Then it kind of go to the assisted living where you still maintain some level of independence, but you also are in a position where you have a little bit more access to ongoing care. Adult daycare facilities tend to see those in situations like the Alzheimer's, dementia, cognitive impairments where you are at home the majority of the time, but you go to a daycare facility or a day facility that gives you care, but it also allows those who are taking care of you, whether it's the caregiver, your spouse, a family member, a little bit of respite time during the week to kind of get things done that they need to be able to get done, and also recharge their batteries. And then finally, the nursing home is that kind of most extreme, most intensive care part of it. That's that round the clock care facility that we've talked about already. So when we talk about the concerns about aging, most people either kind of know what's out there, but they tend not to take action because of one of these common misconceptions. Again, if it's never happened to somebody in your family, it's very difficult to think that it'll happen to you. We tend to be optimistic about our future, so it's not going to happen to me, right? Or if you've never dealt with it before, how expensive could it really be? Why do I need to worry about that? And then also, I thought the government has plans for Medicare, Medicaid. Most people are at least familiar with those two entitlement programs, but they may not be necessarily aware of what they actually cover. And then the last one, and it's something I do hear a lot, is, well, I don't need to worry about it. My family will take care of me. And we'll kind of talk about that one first as a common misconception. So if you think about your family, right? It is, I think, highly admirable and expected that one of the other spouse or a family member would be the primary person to take care of you. I have clients that talk about it all the time, that the spouse takes care of the other one. And I think that's, like I said, admirable. However, that puts a lot of burden on that individual, puts a burden on that family. And without proper planning, it might actually create stress that is maybe unnecessary with that. So then we look at why it's important to have a strategy. Why does it even matter? What is the point of the education of this today, right? It's to help protect assets from potentially devastating costs. It's the idea of, with proper planning, you're maintaining the independence of your decisions. When it comes to that, then you're talking about the freedom to choose where your care is provided. We'll address that as we talk about Medicaid in the future, in future slides. And then again, that last thing, I hate using that phrase burden, but I think it is important when you're talking about that with proper planning, I look at it as you're removing future stressful situations for those that are around you, your loved ones. So with that, the main focus of today is going to be three parts. We're going to talk about the potential cost of care in various different settings. We're going to talk about methods to pay for long-term care. And then finally, we're going to go over the benefits of long-term care insurance and options that you might have available to you. So we look at the cost of care. You can kind of see it can be kind of like an eye-popping amount of money, but these are the figures of the national median costs from last year. So pretty recent data. There, if you look at the most common, is that home health aid and homemaker services. That is, if you're looking at that's looking at, like I said, 5 days a week, roughly that 40 hours a week, $5,000 a month. If you look at that annualized, it's $60,000. And then to the most of the extreme or most needed skilled care is that nursing home at over $100,000 a year. When we talk about the average of about 5 years worth of care needed, you're talking somewhere on the low end of potentially $300,000 in today's money, up to $540,000 plus if it's in a nursing home. Again, eye-popping figures using just today's dollars. And when we look at, talking about what that impact is on planning, we're talking about annual cost of future as well. So we also want to look at, how the impact, and I think it's, it's definitely a phrase, or not a phrase, a word that has been used a lot in the last year plus, but inflation. I think we've talked about it with virtually everything else that goes on in goods and services, but it's obviously, and it has an impact as well on nursing home care and long-term care as well. And when we talk about planning needs and the importance of developing appropriate strategy, we don't want to plan on needing it today, right? We want to look at what would be our need for the future. And this kind of gives you an idea, using a conservative figure of that 4% annual raise rate, what it looks like in 10, 20 years from now. And then this next slide, I think this is important to highlight, depending on where you live, kind of just an idea of various costs across the country. Like I said, from Texas all the way to New York. The other part of it too is not necessarily where you live currently, but a lot of the conversations I have with clients, especially from where I'm located in Charlotte, where we have a lot of individuals that have moved here from other states, is when coming up with a long-term care strategy, it might be, if your kids live in, let's say, Ohio, and you reside in a different state, you may want to actually plan on what the costs are in that state because you want to move closer to your children or other family members. So again, just gives you kind of an idea of how, the previous slides talked about the generalized costs, and this is a little bit more specific to various parts of the country. This is something, like anything else, when you want to look for a nursing home or senior living facility, like you would do, I hope, with any other large purchase, is talk to people you trust, use your online resources, compare different facilities, and visit them with your family members as well. With that said, looking at the costs there, we want to talk about what are the various different methods of paying for this long-term care. So when we look at how you'll pay for it, there's kind of basically 4 different strategies that you can look at. And I always start with the first one, which is the pay out of pocket, because that's kind of everybody's strategy. If you don't have a strategy, that is your strategy. So you pay out of pocket using your personal resources, your income, your savings, investments, whether that's your assets such as your home, other properties you might have, but you're basically your kind of default plan is to use the assets that you currently have. Then there's the rely on government programs such as Medicare and Medicaid. We'll go into that in more detail in a little bit. You can purchase traditional long-term care insurance. You can also look at other options that include life insurance that has hybrid, long-term care riders, or annuity products that have those similar riders as well. But again, we'll start with the paying out of pocket aspect of it. One kind of term that's used there is self-funding or self-insured, and you tend to see that with the ultra wealthy. That's where, for lack of a term, you kind of look at it as I've got enough assets, quote unquote, to have covered all of my other benefits, all of my other needs, my retirement planning and whatnot, and I have enough money to be able to cover whatever costs are coming forward for me. There's more freedom to choose the level of care, obviously, because you're paying it out of your own pockets. And again, it might be ideal for those ultra wealthy individuals. A couple things that you might want to consider with it is the willingness to liquidate assets at a time that it might not be most appropriate. So if you think about that, that's where we're talking about having to sell investments, for example, like in 2022 when the stock market was lower. You might not want to be in a position where you have to sell investments at that time. You might not want to have to sell your house at a time in 2009. So you kind of, when you self-funded, you kind of lose a little bit, lose a little bit of the ability to be selective of how and when you choose to use your money. And then obviously, if you're self-funded, if you run out of money, then you're left with either family members or government options to use. So we're going to the next option, which is, and it might be something that you either heard from various actors on TV or radio, talking about the advantages of reverse mortgage. So we're going to talk about what a reverse mortgage is and how it can fit into long-term care planning strategies as well. So these are essentially allow you to borrow against the equity in your home. If you think about a traditional mortgage, you're paying a monthly payment to a lender. This is the opposite of it. The lender actually pays you a monthly amount that you can use towards, caregivers, home modifications, and whatnot. The key is with this that the loan must be repaid when you vacate the home. So we'll talk about now what the drawbacks potentially are, because it sounds like, hey, if you got a lot of equity in your house, what it might be an option, and it could be. Everybody's specific situation is different. And I have run into situations where the reverse mortgage did make sense, but it's also important to not only highlight the advantages, but look at the potential drawbacks to that. If you're only going to be in your house for a short time, you tend to not see the value of it because there are substantial fees, closing costs that are associated with this type of loan that might actually decrease the equity in your house very quickly relative to the time that you were in need of it. It's important to know that when you move out, sell your home, or die, the loan must be repaid first before anything else is left over for your beneficiaries. And you typically will only be able to borrow a significantly lower amount than what the actual value of your home is. And it's also important to note that while you're receiving money, there is a balance that's accruing over time, and that balance does have interest that is tacked onto that and will eventually, like I said, take away from the equity that's in your house when it's sold. So now let's kind of do a little bit of a thought exercise that I like to talk about with people is, when you're looking at Medicare and Medicaid, that true or false, will Medicare will cover all of your healthcare expenses in retirement, and that Medicaid will cover you in a nursing home. So let's first start with Medicare, and I'm not going to gloss over it too quickly, but I do want to highlight this. I think most people hopefully are at least familiar with the idea of Medicare. For those people age 65 and older listening to this, you are, I'm assuming, well aware of what it is. For those younger, I'll kind of go over a little more detail. But original Medicare is a government, it's the US government health insurance program for citizens age 65 and older, or those younger individuals with specific disabilities or illnesses. Original Medicare is Part A and Part B. Part A covers your hospital side. Part B covers your medical. Part C is a Medicare Advantage plan that is used to essentially basically cover original Medicare and additional other coverages. That may include your prescription drug coverage, have additional benefits that might help with any out-of-pocket costs that you might have. What Medicare does not pay for is personal care or custodial care. There are some situations where home health benefits are limited, but I think the most important thing that we want to look at on the next slide is what Medicare does pay for and what it doesn't, and how you qualify for it. So the first thing that we look at with Medicare skilled nursing facility care is that to even be eligible for it, you have to have a three-day inpatient stay at a hospital that occurs within a 30-day period. If that happens, then they will pay 100% of the skilled nursing care for 20 days. They'll then pay partial amount for the next 80 days. And then after that, they will pay nothing. So it is very, very short and limited in scope and how Medicare covers any sort of long-term care need. So now let's talk about Medicaid. And when we look at Medicaid, so Medicare is completely government run, federally government run. Medicaid is a joint venture that is from the federal and state side. It's actually each individual state that determines its eligibility rules, what it will cover, and so on and so forth. When we look at this, though, I think that chart is really, I mean, it's eye-popping almost on purpose, but if you really look at it, Medicaid is the #1 provider of long-term care in this country. And I think it's a combination of, people who were planning, either lack of planning, thought they could pay for it themselves, and were not aware of the just absolute acceleration of costs associated with long-term care. When we look about talk about Medicaid, a couple of things to consider. It is really designed for low-income individuals. There are certain means tests. There are Medicaid limits on where you can receive care. And again, each state does have their own rules. So the eligibility associated with Medicaid, there are income caps. You typically can only make 3 times what your Social Security benefit is to be qualified for Medicaid. The asset limit, and this is the one that I get a lot of questions about, a lot of conversations with my clients about, is this $2,000 limit. Again, it's a little bit different if you're married, but basically this means that you can have only $2,000 of assets to your name before you would qualify for Medicaid. A couple things that are not counted. That's going to be your house if your spouse is currently living with you. You get 1 car. You have household belongings, small term life insurance policies. There are some Medicaid compliant annuities that are, again, more on a one-off basis. And then burial plots and funeral expenses. So other than that, that is your investments, other property, savings accounts, whatnot. Those all have to be depleted first before you would be eligible for Medicaid. So what is Medicaid planning? This is something that can be done. It does take time, and you have to have really kind of an advanced directive and thought on this. But basically what you're going to do is you're going to have an idea of trying to remove the majority of your assets away from kind of technically your name. So this is transferring them out of your control, which is to an irrevocable trust, giving the assets away, but basically the idea of distributing those assets away from you so that you technically would potentially meet those minimum eligibility requirements for Medicaid. So let's talk about the benefits and the drawbacks of this type of planning. So the benefits are clear, right? You would qualify for Medicaid much quicker than if you had to draw down your assets at that time. A lot of times it's a good way to protect a healthy spouse because those assets are set aside and could be used by them. It also preserves the assets for your beneficiary as well. But the drawbacks, there's obviously, some people have some ethical thoughts on that. This idea of kind of shielding your money to use government resources. It may require you to give up the rights. So what ends up happening is, if you think of an irrevocable trust, you're giving up the rights to those assets in a lot of cases. If you pass them on to your children, even if there's a strategy there that they understand why, you're technically giving those assets away. And then the other part too, and this is something that are going to go in a little more detail, and I also have an example for you on the next slide, but it's this idea of this look back period. And it's something you maybe heard of before, but basically the way the Medicaid laws, the federal law is structured, is that if you are in need of Medicaid care in a nursing home, then what they will do is Medicaid will look back at your transactions or your finances over the previous 60 months or 5 years. And what they're going to look at is, did you transfer assets from your name to somebody else at that time in that 5-year period? And if so, if you did that at a value that was lower than the fair market value of what that asset was. So the best example we can give is a house. So you take your house, you transfer it to your son. The fair market value of the house was $400,000, but you just transferred the title over to your son at no cost to them. So basically the way Medicaid treats that is, they take the average cost of nursing home in your area. So let's say in this example, it's $8,000 a month. They divide those two numbers together. And then what they'll do is they'll basically creates an ineligibility period, which in this case would be 50 months. So that basically means you would not be eligible for Medicaid for 50 months, so over 4 years, before you to be eligible. And you've already now passed all of your assets out. So now you have this strange conversation about how to get those assets back to cover your care. So after looking at the potential cost of care, talking about the various different methods to pay for it, let's talk about what the benefits of long-term care insurance are. So we're going to start with traditional long-term care insurance. This is something that people tend to see this a lot pre-2009, and there were some various different federal laws that changed, but I do see this still with clients. But traditional long-term care insurance is that you are paying a premium to an insurance company for the future benefits of either a daily benefit or a monthly benefit for covered services. There's limits to how much that you can receive. There's limits to potentially type of care that you can receive and for how long. We tend to see these with, so we talked about Medicaid for the lower income individuals. We talked about self-insured for the ultra high net worth or ultra wealthy individuals. All of the things that we're going to talk about from here on out are going to be in those middle, right? The middle income Americans that you kind of want to say, I've got enough assets that I want to address this because I want to protect what else I have. So we kind of look at what or how it works basically. So first and foremost, it's not for everybody. You do usually have to be in good health to purchase a policy. There is some sort of an underwriting component to these. Their premiums are typically based on a couple of different factors. It's going to be your age, your sex, and the benefits that you choose. What usually triggers these is once you cleared an elimination period or waiting period, sometimes it's somewhere between, I've seen 90 days to 180 days as examples of these waiting period before you would be able to access benefits. But basically, once you are unable to do 2 of the 6 daily living activities or chronically ill or cognitively impaired, that will trigger the benefits and start that elimination period. And then the policy will start paying out to help you cover your care. There's some key features that are associated with traditional long-term care insurance. You want to focus on the benefits, the benefit period, elimination period, location of care, and inflation protection. All things that we've already addressed about, especially that inflation protection, where you want the care with that, the elimination period and whatnot. So it's all things that you definitely want to make sure that you're dealing with. When I talk about the types of benefits, that's going to be, I've seen policies that will pay a daily benefit. They usually range somewhere between $50 to about $350 a day. Obviously, the higher the benefit, the more it costs. But it kind of gives you an idea of how it works. So when we talk about how you manage the cost of traditional long-term care insurance, again, like anything else that's associated with health-related things, the younger you are and the healthier you are, the less expensive it's going to be. If you're 55 years old and in good health, it's going to be less expensive than if you're 70 years old and just healthy enough to qualify. One of the downsides to kind of think about long-term care insurance, traditional long-term care, is if you get it at a younger age, you may be paying that premium for a significant amount of time before you ever have a position to access those benefits. You also want to look at it as a situation, and if you own it, you're familiar with this, or you maybe have heard other people talk about it, but basically most states, not every state, but most states are allowing insurance companies to increase the premiums on an annual basis for these traditional long-term care insurance policies. So what happens is you get a letter in the mail and you have a decision to either reduce the benefits and maintain your premium, or to keep the same benefits that you'd previously selected, your premium could go up. So something you want to take into consideration before purchasing anything like this. There are some tax advantages that are associated with your long-term care insurance premium. I always recommend that you talk to your CPA or tax professional about anything specific related to this, because it does come into play with the qualifying medical expense deduction. But I just want to highlight that there are potential tax advantages when you pay your premiums for long-term care. And then obviously the last thing is it's kind of a, when it comes to traditional long-term care insurance, it's just make sure you're paying attention to the key policy features that you might want to consider with each of the policies that you could select. So now that we've kind of talked about traditional long-term care insurance, let's talk about the other options that are available, other insurance options. You have hybrid life insurance products that I'll go into here in a second, and then also deferred long-term care annuity products as well. So hybrid life insurance, and before I go into this in detail, I kind of want to give a personal example about this. So with the previous one, with the traditional long-term care insurance, if you don't use the benefit, you've been paying those premiums for, I don't know, 10, 15, 20 years, and you pass away and never needed the care, your beneficiaries don't receive anything. It's a kind of use it or lose it policy, similar to think about like auto insurance or homeowners insurance type of a mentality. And that might be fine. But then you also run into a situation where these hybrid life insurance. So my grandpa was diagnosed with pancreatic cancer. He died within 2 months of being diagnosed. My wife's grandmother was diagnosed with dementia. She lived 8.5 years. My point behind that is that we just don't know how long or if we would need the care. So that's why there's these hybrid life insurance policies. So what they basically do, the positives of them are that when you select one of these, the premiums are guaranteed. They are flexible. So you might have situations where you can pay all up front at once. You can pay over 10, 20 years or your lifetime. So you're a little more flexible on that, but the premiums will be guaranteed not to increase. They might be easier to qualify because there's a component of both life insurance and long-term care insurance. The other part of it as well is that if you don't use it, right? My grandpa's situation, if having this type of policy, wouldn't be able to, most likely was not going to be able to use the benefits of the long-term care. There is a life insurance component that benefit would have been received by his beneficiaries. The negatives behind it is they tend to have less coverage than a traditional long-term care insurance policy. They're a little bit less customizable on that. They may not include inflation riders on it, so you kind of want to be careful in selecting the benefit for it, kind of plan ahead on that. And you might not be eligible for some various different state Medicaid partnership programs that are available out there. So now I'm talking about deferred long-term care annuities. It's going to be kind of similar to the hybrid life insurance. The idea is basically you have a annuity, usually all single premium payments. They have some sort of a fixed interest rate, and then they also offer these long-term care riders on them that would be able to allow you to access a leveraged up amount towards long-term care. Again, they tend to have actually even less benefits or more stringent requirements than on those benefits than even the hybrid policy. But the positives of these are they are easier to qualify for than any life insurance. So you will see these used by individuals that may have a little more difficulty based on health or cost to qualify for the other options out there. Talking about tax-free HSA distributions, I think it's very important for everybody to realize if you have access to a health savings account, which again, there are certain requirements that you have to have. You have to be in a high deductible plan, and there's some other tax-related requirements there. But one of the advantages is when you come to retirement planning and long-term care planning is you can put money away in these HSAs that are tax-free or pre-tax money. And then when you go to distribute them, and you can use that money to help cover some of those long-term care insurance premiums that you have. And it's a way to kind of offset tax-wise offset the costs that you might incur by the premiums on the traditional long-term care insurance are a little bit higher. And then we can go to the next slide there. And then, so when we talk about this, what is the, thoughts on here that you're getting, when you come to planning, why is it important to talk about planning now and not waiting, right? So you want to do it when you're healthy enough to take advantage of the options. It is probably the most critical point when it comes to this. It is not one of those, it's kind of one of those things that people say, and I've had clients come to me and say, I want to get one of those long-term care policies. And I usually ask, well, what happened? It's because they had something happen health related that it's now front and center to their mind, but unfortunately they wouldn't be able to qualify for it at that time. When we talk about Medicaid planning, again, you need to have time on your side. At the bare minimum, that 5-year look back period, and then also the considerations around, how do you appropriately transfer assets in a way that you would not be subject to ineligibility of Medicaid benefits. And then, again, there's that relieving the family burden. I think it's just a matter of, with whatever kind of planning you're talking about, the whole purpose of it is to be in a structured format that allows your family and you, for that matter, to be well aware of what the decisions are in the future to really alleviate any of those stressful moments. There's a little checklist that I always think it's important for everybody to understand when we're talking about long-term care planning. So you want to explore the services and costs in the area. You want to assess your finances. One of the strategies or one of the kind of homework assignments that I have with my clients is write down what assets you have, from your savings account through your investments to your house or whatever. And you write another column and say, what are the purpose of those assets? What ideally are those assets to be used for? And that's a way for you to really assess your current finances and give you an idea of, whether you're able to self-insure, whether you're not, and whether you want to look at other options available to you. You definitely, before looking at any options, you want to use a financial professional that you trust, that can kind of give you the various different options available to you, the costs and the benefits associated with it. Talk about healthcare directives. So with our firm, we also have we use a estate planning attorney that's part of it. And one of the conversations that we want to look at, it's not necessarily the cost of long-term care, but it's more about you having control of what happens in the future. So this is your medical directives, this is your living wills and whatnot. So I highly, we talk about the importance of working with elder care planning attorneys and whatnot to be able to come up with a good plan. And then hard part there, it can be hard and kind of morbid sometimes to talk about, but it just makes it easier if you just have that conversation with your family, talk about your plans ahead of time. It makes life a lot easier. That would be if you're going to move to their location or whatever it might be, but definitely something you want to consider. So now there's a lot of information here. Talked about several different things: Medicare, Medicaid, what long-term care insurance is, traditional, all these different things. So let's put that knowledge to work, right? You can do it a couple of different ways. You can do it yourself, hopefully use the knowledge that you learned here today to start working on it yourself. If you're not comfortable doing it yourself, work with a financial professional, an advisor, to help kind of give you a more specific plan. What I would not recommend is procrastinating, right? You don't want to do that for various reasons that I've really addressed over the last several minutes here. But hopefully it's something that you can take away from you today and put this to work on there. I do want to thank you, like I said, for the time. I commend you all for taking the initiative, for wanting to improve your financial situation. And I'm here to answer any questions that are available.
All right. Well, we did have a couple questions come in, and I will encourage you to go ahead and put those in the chat if any questions come up. So is it true that certain states like the California recent law will charge long-term care taking out from each paycheck starting next year, just like Washington? I know there's been some new legislation.
So that, and I wish I would be able to answer that question specifically, but I'm located in North Carolina. I am not 100% familiar with the specific rules associated with that. I do know every state is, or not every state, but a lot of states are looking at potential different law changes here. I would recommend, talking to expert in California to give you that specific answer.
Yes, and I believe we've done some webinars about some of these issues, so you're welcome to kind of look that up on our website and look for that. Okay, here's a good question. How do you decide which option is best for you? You went over all these different options. What are the factors that go into actually deciding?
Yeah, so I would start first and foremost on assessing the assets that you currently have. You know, if you've got, I work with people that have had, sizable, let's say CDs or liquid assets, and they might say, you know what, I just want to be done with this. So some of those single pay options might make more sense. If you're not in a position like that, then you might want to look at ones that are a little bit more low cost for you on an annual basis. The process that I usually go with is we assess what the assets that you currently have. We talk about your health, and be honest, by the way, whoever you sit down with, because there's an underwriting questionnaire, and it consistently happens that people tell me they are in perfect health, and then it comes back and I'm like, how did you even get in here today? It's as an aspect of that. So be honest with your financial professional on that, because it's our job to give you that best solution. So we kind of start with, what has the best benefits. There are policies out there. I talked about the ones that cover for certain periods of time. There are policies that have lifetime benefits. And so a lot of times we'll start with that, right? That's the kind of Cadillac of options, because when we talk about the cognitive impairment, the Alzheimer's, dementia, you can live potentially a long period of time and need a significant amount of care that's going to be expensive. So you want to maybe find those ones that have that lifetime option. You kind of work your way, for lack of a better term, kind of down the line until you start at the top and kind of work your way down to find the right and most appropriate policy for you.
All right. And it is individual to everyone. So it's not
absolutely.
So here's another question. Is there a general guidance on thresholds for couples in good health for self-insuring versus buying long-term care insurance?
Yeah, that's obviously every situation is different. And it is one of those that you, like I said, you want to assess your own personal one with a financial professional. But just to kind of give you an idea, I tend not to like to use there's not a real number, right? Everybody's situation is different. I have clients that I work with that could technically be self-insured, but what they do is they say, well, I don't even want to worry about it. So I might as well look and purchase one of the options there. So that way, at least I know that's covered, and it really protects the rest of the assets for the potential surviving spouse, children, what other beneficiaries or thoughts they have, charitable giving and whatnot they have. I think it's worth at least having a conversation with it. I have also had conversations with clients and said, after addressing and looking through each individual, what assets you have, what needs you would need to cover, that I've looked in from, you can self-fund, you can self-insure, because we just can't find another reason why you would use this portion of the money. So I think it's each individually based. It's not a specific dollar amount. It's a lot of times more, what are your current expenses? What are future expenses related to what income and assets that you have?
All right, here's another question. What about inflation riders? Can you talk about what kind of inflation rider rate would be? So they're saying like $100 today won't be the same 30 years from now.
Absolutely.
Kind of what is a good rate for that, or is that already set in the policy? Talk about that.
Yep. So again, this is going to be very broad based because there are so many different insurance companies out there, so many different options available. But just to kind of give you a general idea, there's a couple of ways to address future inflation. So there are policies that will have, I've seen like 3% annual riders on it, or 3% increase in new benefits for inflation, 5%. There's simple interest, compounding interest. Obviously, the higher the inflation rider and if it's compounding interest, the more expensive it's going to be. because they're going to be ratcheting up those benefits quicker for you over time. What happens a lot of times, though, is there's a couple of ways to look at it. It's a really cost benefit analysis. So I've looked at where say we're going to kind of build in future inflation today. So just using an easy number, if our goal was to get 5,000 a month of benefits using today's money, we'll kind of guess out what that would be in maybe 10, 20 years. And maybe let's say it's 7,500, right? We come up with, 7,500 or 8,000, whatever, and just use 7,500 as a number. So instead of, we'll look at what the cost would be to buy a $5,000 benefit today with an inflation rider, and we'll compare that to buying a policy that has a $7,500 benefit with today's dollars with no inflation rider, right? So we're kind of building in what that future inflation might be, and then we'll kind of analyze those costs together. Because one of the things that also, it's tough to think about, but when you look at it is with the inflation rider is what we're trying to guess when you would need the coverage, which is a really difficult thing, right? Trying to predict your future health needs. So that's why sometimes we'll look at, well, let's just say what it would be like in 10, 15 years and just buy a benefit for that amount today. And then if you needed it in 5 years, then you're actually ahead of the game, right? You got a higher benefit than expected. So it's a little bit tricky in there, but there's several different options to select from.
All right. Someone had asked for a specific slide, and I'm looking through so I can show it to you again. But before that, you talked a lot about the surviving spouse. So this particular question is about like, I am worried there's an age gap between me and my spouse, and I am anticipating being a surviving spouse. How can I make sure I have enough to live on when my spouse passes away?
Yeah. So one of the things that we've talked about with our clients is that's where you'll see sometimes those like hybrid life insurance policies used that have they kind of do twofold. So they will, if needed, if your spouse, I think in this example is there's an age gap there, so they're older than you. Let's say they need that long-term care at that time, that you have that benefit there, and it's helping to protect the rest of the assets that you have that would be used for you at the time if if and when they pass away. Let's say they pass away though before that, right? And they didn't use the benefits. Well, now you retain that value. There's there's usually a death benefit associated with it that's going to be on average higher than what you put in. So it's kind of a way to protect you on both sides. I would also, if you're significantly younger, that's also a conversation about you purchase two separate policies, right? One for them and one for you. If you're younger, it's going to likely be cheaper and something that you would be able to take advantage of to protect yourself in the future for a potential need that you might have down the road, that you might not have those other assets associated with you at the time that they would pass away.
All right. And I did find that slide. Someone was asking for this slide. So there you go again.
Other websites.
Yeah.
I would also encourage, like I said, in your wherever you guys are located, there's use these resources. It's like, I look at it as, we have a lot in our area here in Charlotte. Charlotte's I don't know how familiar everybody is with it, but it's a community that has grown significantly over the last 15, 20 years. We have a lot of, college graduates, and then a lot of what I say parents of those college graduates that are moving here. So there's been a huge increase of senior living facilities. There are ones that, and I can think of a couple in our area, so I'm sure they've got to be around all over the country, that are, each stage is already built into the senior living facility. So you might have a full independent, like an apartment, and then you have the option to go to like a skilled nursing, and then that nursing home, all in the same area, in the same building or same complex. So that might be something that you want to kind of look at. Obviously, the long-term care wouldn't necessarily cover you in that first part, that apartment living style, but you would have already predetermined where your next stage would be, and then the cost, and then the way that you would cover that additional cost.
Very interesting. Well, we do have another question here, and we're going to end with this one. And again, if you have more questions and we haven't been able to get to it, just go ahead and leave that in the chat. We'll make sure someone reaches out to you, and make sure to put your contact information in there as well. The question on timing, how early should you look at long-term care options? Like, give kind of maybe a general age range there.
Yeah, I would say that, I hate to give an exact age, but I would say, like, that 40, 45, you start having that conversation. I will say this, if you are, if you're under 50 and have already accumulated, a pretty decent amount of assets, significant assets, or have high income, you might want to consider using this, because it's a way to divert, or invest in something that you're going to need in the future at a much younger age, and the cost might be cheaper. I would say, though, at the bare minimum, once you've hit 50, you're that 10 to 15 years out from retirement, it should be part of every retirement plan. It doesn't mean that everybody purchases some sort of policy, but it should be part of any retirement plan. And you really want to, when you're in that kind of red zone area of that 5 to 15 years out, it should definitely be a conversation at that time. You just don't want to, it's not one of those things, it's not just about like waiting too long, and it's just typically when you go to, it's like any other insurance, right? When you go to need it, you can't get it, right? It's because you don't qualify for it. So you kind of want to think about it younger and as early as possible, but also make sure that you have the ability to pay for it, and you don't want to be putting money aside that is detrimental to your other financial goals as well.
Yeah, thank you so much. I really appreciate your time and all the questions you've addressed. We appreciate the organizations that have made our webinar possible today. To our attendees, look to your email for a link to the replay of this event, and you're welcome to share that replay with friends and family. It's a good way to start planning. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, everyone, thank you so much again for coming, and we hope to see you at another educational webinar soon. Goodbye, everyone.